So let's talk about a company that's almost certainly powering the device you're watching this on right now, ARM Holdings. In this crazy, high-stakes race for AI dominance, we've got to ask, is this quiet, unseen powerhouse about to become the real ruler of the entire industry?
You know, whenever anyone talks about the AI boom, our minds just jump to one thing, right? GPUs. Those massive, power-hungry chips that are essential for training large language models. For the last couple of years, that has been the whole story. But what if that story is about to get a major plot twist? What if the next huge wave in AI isn't about teaching models anymore, but about getting them to actually do things in the real world? See, this is where the whole game changes, and all of a sudden, the good old CPU becomes the star of the show. What we're seeing here is a huge shift in the AI world. We're moving from an era of just learning to a brand new era of acting. And that transition, well, it changes everything. The tech that's making all this happen is called Agentic AI. The best way to think about it is like this. A regular AI is like a library. It has all the information. But in Agentic AI, that's the librarian. It actually understands what you want, goes and finds the right info, and then takes action for you. And that kind of job requires a totally different kind of brain, one that's great at handling tasks in order and managing complicated systems. It needs a CPU. Okay, so why is ARM in such a perfect spot to just completely dominate this new AI landscape? Well, it really boils down to two incredibly powerful advantages, or moats, that are just ridiculously hard for anyone else to get around. First, their power efficiency is just unmatched. And second, they have this massive, almost unbreakable lock on the entire ecosystem. Let's dig into what makes these two things so incredibly powerful. The efficiency advantage ARM has is, well, it's just staggering. You've got these modern data centers that are literally hitting the physical limits of how much power they can use. And ARM's architecture comes in as the perfect solution. Just look at NVIDIA's Grace Blackwell system. It gets a whopping 25 times better energy efficiency, and a huge reason for that is its use of ARM-based CPUs. And that kind of leads us right into their second huge advantage, the lock-in effect. I mean, you have over 400 companies designing chips based on ARM's blueprints. You have literally trillions of lines of code that have been written specifically for its architecture. Switching to something else, it's just not practical. The cost and the effort involved create this massive wall that keeps competitors out. All right, let's switch gears and look at the money side of things. Because this isn't just a cool tech story. It's a story about how insane profitability is being used to make a huge push for future dominance. This table right here tells such a fascinating story. First, you see that gross margin? It's almost unbelievable, right? That comes from their super profitable model of licensing their intellectual property and collecting royalties. But then, look at the operating margin. It's way lower. So what's going on? Well, ARM is just pouring billions of dollars back into R&D to make sure they stay on top. And they're doing all this while keeping their finances incredibly stable with very little debt. I mean, let's just pause on this number for a second. 97.5% gross margin. Seriously, what kind of company even hits numbers like that? That's the power of a business that doesn't really sell physical stuff. Instead, they license out the fundamental blueprints for an entire industry and then just collect a royalty on pretty much every smartphone on the planet, plus countless other devices. So here's the absolute key to understanding ARM's sky-high valuation. You have to stop thinking of them as just another chip company. The market, the investors, they're pricing it as if it's essential, irreplaceable infrastructure for AI. It's like owning the railroad tracks for the entire AI revolution. But of course, it's not all sunshine and roses. The potential is huge, but it's matched by some pretty significant risks. It's a real tightrope walk for investors. Let's take a look at the potential downsides. Okay, so there are really three big risks to keep an eye on. First, ARM is actually starting to sell physical chips now. That's a huge change from their high-margin royalty business, and it brings in a ton of new headaches like managing inventory and supply chains. Second, by doing that, they could end up in this weird spot where they're competing directly with some of their biggest customers, like NVIDIA and Google. And finally, the stock's valuation, at over 60 times forward earnings, is just astronomical. It basically leaves zero room for any mistakes. One little misstep could cause a huge drop. So, when you weigh those massive rewards against those very real risks, how are the pros thinking about this? Let's break down their investment playbook. And right away, you can see there's a huge disagreement here. You got the conservative analysts, like the ones at Morningstar, who are saying, hey, all that future growth is already baked into the price, putting fair value down around $135. But then you have the optimistic models that see a clear path to 251, assuming ARM keeps up its high growth and expands its margins.
Now, if you translate that optimistic target into a real-world return, you're looking at a potential annual return of almost 29% over the next 2 years. I mean, that kind of upside is really tempting, but you have to remember, it all depends on the company executing absolutely flawlessly.
So based on all that, some analysts are suggesting a very disciplined 3-step buying plan. It starts with a small initial position at today's prices, just to get some skin in the game and avoid that feeling of missing out. Then you build your main core position at a much better price, somewhere around that $130 to $135 level. And finally, you save that last bit for a potential market panic, a moment of extreme fear where you can maximize your position at a really deep discount. So the consensus strategy really just boils down to this one simple phrase: accumulate on dips. The idea is don't chase the stock when it's hitting all-time highs. Instead, use any market weakness, any volatility, as your chance to build a position in what could be one of the most foundational companies for the next decade of technology. And that really leaves us with one last fascinating question to think about. Yeah, the valuation is high, no one's denying that, but in an age that's going to be completely redefined by AI, is the biggest risk of all not paying the premium it takes to own a company that has a near monopoly on the very foundation of that future?